Nancy Anderson. Nancy Anderson is an associate professor in the School of Business at Mississippi College, and she's here with answers. Great to see you again.
Good to see you.
You always inform me of so much about money, and this is true. We hear the word inflation on TV all the time,
and
but
we're
it
hearing
just
it a
seems
lot
like
now.
this.
Yes.
Yeah, it seems like this term that's just for government people. How does it affect us?
Right. The classic definition is too much money chasing too few goods.
Okay.
And we don't have inflation right now, despite what you're hearing out there. If you're shopping, you know that. You know you can get a deal on a house and a car, on clothing. All of those things are on sale. Now, for my older clients, they think we have inflation because they're not purchasing those things right now. They're not buying new furniture and new houses and new cars. And they're seeing their grocery bills go up, and they see gasoline going up, and they think, oh my goodness, inflation. But we don't have those conditions. It is measured by the government, and it is measured by something called the CPI Index, which is the Consumer Price Index. And this measures the change in prices in a typical basket of goods that we might buy. And there is a little bias in there because it's only adjusted every 2 years. But we really look at the real return that we earn on our money. But we tend to focus as consumers on our nominal return, which means our stated return. We hear what CDs are paying down at the bank, and we forget that that factors into the inflation and the real rate of return. So if you have a 3% return on your CD and we have 3% inflation, then your real return is really zero.
Yes,
right?
That's right.
We do know that inflation averages over the long haul about 3% a year. But again, we don't have those conditions right now. And in fact, we are concerned about deflation, actually prices falling. Inflation is linked to interest rates. So as inflation goes up, interest rates go up. So be careful what you ask for when you look for higher rates on your CDs. That means all those prices will go higher as well, because high inflation is really bad for growth.
Right.
If it gets so high, then what will happen is that we'll spend all of our money now because we know it's not going to be worth as much a year from now.
And we know interest rates right now are just very low. For
Right.
a savings account,
Right.
you're
But
barely
don't worry
getting
about
any.
that.
Right.
Don't worry about that. In these conditions with very low or no inflation, then that means your real return is still in the positive territory, and that's a good thing. And of course, we always hear back in the late 70s and the early 80s, my goodness, we had double-digit CD rates, but we had double-digit inflation
Yes.
too. We had 10, 13, 14% inflation. We can't imagine that right now. So just remember, low inflation and low CD rates will go together. It's going to track your interest rates. Concentrate on the real rate of return, which is what you earn after inflation.
Yeah, in fact, when I think about inflation, I think about the late 70s, because that's when the
Yes.
word really
Were you even around then?
Actually, I was. I know I'm aging myself by saying that, but
Yes.
yeah, I remember, and that's when we started seeing that word so much.
Right.
But really, okay, if we're talking about deflation, we're talking about lower prices for goods.
Right, right.
So it's a good thing.
So not necessarily,
Okay.
because it can really drag our economy down.
Right.
So we want to have just a little bit of inflation, but of course the Federal Reserve is always watchful that we don't get carried away. And
Got it.
so maybe down the road we'll have inflation, not now.
All right, Dr. Nancy Anderson, thanks a lot.
Thank you.
All right, coming up, your weekend forecast. Stay with us.